So hi, I'm Kamal Hassan, and today's talk is going to be about removing bias in angel and venture investing. Just so you have a little bit of background on myself, I am a founding partner of a fund called Loyal VC, which is 3 years old. We've invested in 200 companies across 46 countries, including a couple of companies out of Australia. Before that, well, I've been a serial entrepreneur. I've been an entrepreneur in travel publishing, in hardware, software, telematics over the past 20 years. I've also been an angel investor for 15 years. I counted it up the other day, and I've actually advised or mentored over 500 companies. So I've seen a lot of what goes on in innovation and entrepreneurship. Before I became an entrepreneur, I was a consultant at Bain & Company, MBA from INSEAD, and an engineer before that. But having sort of experienced entrepreneurship from both the point of view of the entrepreneur looking to get funded and from the person doing the investing, I learned a few things, and I'd be very happy to share some of those right now. So the first question you have, if we have a topic like removing bias in angel and venture investing, is the logical question: is angel and venture investing biased? Because maybe it isn't. However, the gender data alone seems pretty damning. If you look at Crunchbase, for instance, in 2019, global VC investment in female-founded startups peaked at 2.8% of all VC dollars, and it actually fell back to 2.3% in 2020. So if you look at that, you just looking at those data, it sort of says something strange seems to be going on here. And by the way, it isn't just in gender. Gender is only one kind of bias that you see show up. If you take a look, this is data from CB Insights for investment in entrepreneurs out of the US. And you can see a similar bias by race, where 87% of all investments in white entrepreneurs, only 1% in Black entrepreneurs. So you've got a massive disparity downwards in Black entrepreneurs, American Indian others, and upwards in both white and Asian entrepreneurs. Now, I'm going to spend most of the talk referring to bias. I'll sort of inform the talk with gender bias statistics, because those are much more easily available. But anywhere I'm talking about bias, gender is only one kind of bias and is sort of a proxy for multiple kinds. So let's just talk about the financing market, the entrepreneurship financing market on a gender basis. If you look at the far left-hand side, obviously around 50% of the population in the world are women. And according to one source I've seen, they control about 33% of the wealth. Now you look at the far right-hand side of the entrepreneurs, and depending on the data source, somewhere sort of 36 to 42% of entrepreneurs are women, and yet they're only getting 2% of VC funding in 2020. So you can see there's sort of a big drop off here between the control of wealth by women and the amount of wealth invested into women entrepreneurs. Now, there's a couple of ways for the money to get into entrepreneurs. One way is by wealthy individuals investing directly as angels. And according to one study I've seen, around 22% of angel investing happens from women. So already there's a drop off there, although nothing like the end result. And then the other way that women can invest in entrepreneurs is they can invest as limited partners in venture funds. And the venture funds themselves can invest into the entrepreneurs. And here at the venture fund stage, you see somewhere between 16 to 21% of the investing professionals who are women. So there are, so you can see that there's sort of a drop off along the way, but it's sort of 50% of the women with 33% of the wealth. In the middle here, something on the order of 20% women, and at the far end, 2% of the dollars in VC going to women entrepreneurs. So there's a remarkable drop off through that process. Now, logically, you'd say, okay, well, great. If there's bias in venture capital, the solution is to hire less biased investors. And why don't we hire more women? And presumably women will not be as biased against investing in women if bias is an issue. So this is really is the person biased theory, which says, okay, hire less biased people, you don't have a problem. Well, you'll remember I said initially, according to Crunchbase, global VC investment female founded startups is 2.3% in 2020. And it sort of fallen off from 2.8 to 2.3%. During roughly the same period, according to Crunchbase, women have gone up from 11% of the VC deciders, the VC investment partners, up to 16%. So we've got a growing number of women here who are making the investment decisions, and yet a flat to falling number of dollars going to women. So hiring more women doesn't seem to be the deciding factor here. And there's actually, surprise, surprise, there's actually a really good study done by out of Harvard, which basically took a identical pitch. It was a pre-recorded pitch voiced by both a man and a woman, and then they gave photos of the man or the woman, and they discovered that the scores vary dramatically depending on looks and gender. So the same pitch given by a good-looking man scored on a do you want to invest, scored an average of a 5.21. A bad-looking man scored a 4.59. Remember, identical pitch. So you can see there's a dramatic impact at how good-looking the person presenting the pitch is, how much that impacts the score. And then if you look for women, so bad-looking men outperformed bad-looking women, and the worst performing at all with a score of 4.14 was good-looking women. Now, the difference here, maybe it's small. I mean, you can argue about how much of a difference there is here, but you can definitely see the good-looking man bias is dramatical here. And what's important to emphasize is these relative results were the same no matter who was doing the scoring. So if you're a man or a woman, you score good-looking men the best, good-looking women the worst. So this is just a pure study, identical pitch, voiced with photos of the presenters. So it really looks like there's something going on here in terms of a general bias across all kinds of investors. So hiring more women doesn't seem to be moving the needle. Let's talk about something else here, which is a possible factor at work to be aware of. There's something called the gender confidence gap. So men and women, well, what they did here is they asked men and women how they would do, and this is studies out of one of the University of California, I think the UC Santa Barbara. They asked a series of men and women how they would do on a variety of tasks which they were about to be given. And the men consistently overestimated their abilities and overestimated their subsequent performance. And women routinely underestimated their abilities and subsequent performance, and the actual performance did not differ in quality. So both men and women performed the same. The men were overconfident about how they do. The women were routinely underestimating what they would do. So you can start talking about, okay, maybe women project a lack of confidence when they pitch, maybe they make smaller promises in their pitch, maybe they approach fewer investors because they have less confidence, so they will give up. That's actually something when I was pitching for money, I still remember I had a list of, I have a list of 500 investors who I'd approached for one of the companies that I was running for fundraising. So it's certainly something that is where numbers do make a difference. But there is this potential gender confidence gap if we want to talk about gender. But fundamentally, I think what happens is investors are asking the wrong questions. So I'll give an example. I was in Switzerland and there were two entrepreneurs who were asked to pitch on stage about their business in this sort of venture capital conference. And the woman started off and her pitch was, I have a detailed plan for how I'm going to, in fact, they were asked, tell us about the future of your company. And this woman said, I have a detailed plan for how I'm going to build this business to a 100-employee business. The man stood up, same question to him, and he said, this is going to be $1 billion business, and let me tell you why. Now, the thing is, maybe she's right, maybe he's right, we don't know. He wants to be $1 billion business. He's got to be a 100-employee business before he can get to being $1 billion business. Is the woman who's got the detailed plan to get to 100 employees first, will she outperform him and get there faster because she's got a plan and he doesn't? Or is his vision going to outperform? But the bottom line is, when we're having these conversations, we're talking about future plans. We're talking about things which are fundamentally unknown. And this is one of the big problems I have with pitches, is this sort of dealing in the unknown. Lots of pitches are about how big the market is, what market share I'm going to get, what my financial forecasts are going to be. And you're asking people to theorize about things in the future. And we already know men will dramatically overestimate what they're going to be able to do in that time, and women will routinely underestimate it. So by asking anything about the future, we are introducing immediate bias. Now, it's worth mentioning, if we're talking here about venture capital and the approach which is being used in bias, let's just spend a minute talking about results. If you look at the deal by deal returns, and this is from over 20,000 investments, VC investments in the US, and this is VC, but the numbers look fairly similar for angel investments, you see that 2/3 of the deals fail. 31% give you 1 to 10 times your money back, median of around 3 times your money back, and 4% give you 10 times your money back or more. So if you're sitting here looking at this, you've got to ask yourself, okay, maybe there are some challenges with how venture is doing, sort of running their business right now. And by the way, you could also look at them and say, why would anyone ever invest in venture capital? And it is worth mentioning in the right-hand side here that venture capital does work at scale, because those 65% of losses are covered by the 31% who give you a little more than 3x. So on this first 96% of your deals, you come out flat. But the 4%, 1 in 25 venture deals, will give you over 10 times your money back. And if they give you 25 times your money back, your fund doubles. If they give you 50 times your money back, then your fund is going to do extremely well. So a lot of the returns, and this is why, for those of you who are entrepreneurs wondering why VCs are always interested in massive markets and everything else, is every deal when they do it, they think it's one of these 4% of home runs. So the big question which comes out of this when you start to look at the data is, why use the pitch process? We have proven from academic research that pitching preferentially selects for gender and looks. So why would you use a process to pick the best investment, which you know is going to pick the best looking man, not the best investment? We also know pitches have a lot of forward-looking information, and men are consistently overestimating their future performance. And anyway, future plans are completely the realm of the unknown. So why are we making investment decisions based on things which are unknown? So really the conclusion from this, and we want to talk about investing with less bias, you really need to hone in on the pitch itself. We've seen from earlier, having women making the decisions doesn't seem to make any difference whatsoever in the outcomes. The outcomes are still biased for gender and looks. So if you know it's a biased process, you know that pitching is inherently biased, why not ditch the pitch? Get rid of the pitch, and that'll be a great way to eliminate bias. So then, of course, you're going to ask, well, okay, if you're going to get rid of pitching in venture capital, well, how are VCs supposed to pick their investments? And there's a very simple answer here, and I'm going to use 3 funds as an example. The first thing you do is start funding entrepreneurs based on their past results and their current metrics. Fund them based on what they've done. When you ask somebody what they've done, it doesn't matter if you're a man or a woman, you can talk honestly about what your results were, what your metrics were, and as you do that, you dramatically reduce gender bias. And of course, as I mentioned at the beginning, bias is not just gender, bias is also racial and other. But the wonderful thing of this process is when you fund people on their metrics and their results, then a lot of those biases go out of the way because it's easy to just look at the numbers and say, this business has outperformed this business. 3 examples here. There's a fund called Social Capital out of the US, which ran for about 3 or 4 years before shutting down because of politics among the founders. Before they closed down, the way they worked is they had a simple online form you filled in if you were an entrepreneur looking for funding. It didn't matter where you were in the world. It didn't matter who you were. Fill in the form. They'll evaluate the numbers and fund you based on your numbers. When they were running this fund, 40% of the companies they funded had women CEOs, which sounds dramatically different, of course, from the 2% of VC dollars that go into companies, women-led companies. Another company, currently existing company out of Canada and the US called Clearco, used to be called Clearbank. Again, they fund SaaS companies. You put your data into a website and they basically look at all your data, all your SaaS metrics, and from there they choose who to fund. And according to them, they haven't quoted their exact percentage of women, but they say they fund 8 times more women than the VC industry average. So let's assume they're in sort of the 20% range minimum, depending what they thought the VC industry average was. And then we have our own fund, Loyal, and our own fund has around 30% women CEOs in it. So you can see when you fund based on results and metrics, it's really making a dramatic difference to bias. Now, what we do at Loyal is we start with very small pilot investments. We try to make sure that you've got gender balance on the way into who qualifies for the pilots. And then all follow-on decisions are based on working with the entrepreneur for many months and watching them perform. So if there's a woman who underpromises and overdelivers and a man who overpromises and underdelivers, we, by working with them through this pilot phase, get a chance to see who is over and who is sort of how they're actually performing compared to their promises. And then you can fund people based on those real results. Many venture capitalists, when asked about investing more in women, will say, you know, I'd love to, but, and the big but is, I have a fiduciary duty to my investors to make the most profitable, to make the best investments. And I cannot use gender, race, anything like that as a metric, because then I am no longer making the best investments. Well, I would argue if you invest only 2% of your dollars in women, by definition, you are not making the best investments. And the way to ensure you make the best investments is set targets. If you set targets for yourself as an angel investor, as a venture investor, if you have real measurable targets that you are holding yourself to, you will ensure you diversify by gender. And by the way, there's this lovely, much quoted study out of BCG a couple of years ago, which found that women-founded businesses generate twice as much revenue per dollar invested than male-founded businesses. Now you can look at this and say, okay, well, women are better. But I don't, if you remember that study I quoted a little bit earlier, where it said, and based on future performance, men and women performed about the same. It's just men were overconfident and women often underestimated what they would do. Well, in a world where you've got only 2% of dollars going to women, women are underfunded. So it is unsurprising that the women who do get funded will be probably the best of the women, and hence they are more likely to outperform. So it's unsurprising the women-founded businesses generate twice as much revenue. And I actually think that women and men run businesses around equally. And if we'd fund women more, then we'd find the returns from women-founded businesses would be roughly equal to the returns from male-founded businesses. It's just sort of supply and demand of capital. So returning to fiduciary duty, okay, well, you should be investing in women-funded businesses. They're underinvested in, they're giving you better returns. And if you say, I'm only going to fund the companies I think are the best investments, what you're really saying is, I am going to disproportionately fund good-looking men. And the only way around that is to set yourself explicit targets of a percentage of your portfolio that will force you to think about what you're doing. And the second you can see you're missing your targets, it will force you to take a look at women, racial minorities, whoever it is that your fund is overlooking. If you're not seeing enough pitches from them, you will go out and look for them if you have these targets you've set. And I would suggest start with something simple, 10% of dollars to companies run by women. Look at your racial makeup in your country, pick a fraction of the racial makeup, but set aside a minimum to ensure that you're not overlooking the best businesses. Now, this is sort of sexism, racism, ageism is just one kind of bias in VC investing. And we've spent a lot of time as a fund thinking about all the different cognitive biases that you can run into as an investor. So for instance, so there's two types of investing. There's the initial investment you make in a company, and then there's the follow-on investment. So what you will see, for instance, is sunk cost. When you say, I've got to save my investment, my company's in trouble, I will give them more money to save them. You've got something called the endowment effect, which is, hey, once a deal is mine, I've pitched it to the investment committee, it becomes more attractive to me because I see it as part of myself, part of my identity almost, and therefore I like this company because they're my company. You see overconfidence, where people see a business and they're convinced it's going to be the next Google, and they put a ton of money into it. We don't know the future. Maybe it will be, maybe it won't be, but there's a lot of venture investors who suffer from overconfidence in their investing. There's also this bandwagon effect. It's really we have a heuristic, a sort of a decision-making criteria in our brain, which says what's unavailable is more attractive. Similarly, if everybody wants to jump into a certain investment, that must be a good company. Oh, we're the only investor in this company over here, there must be something wrong with it because nobody else is interested. So there's this real, call it the lemming effect, when people are interested in an investment, and a good entrepreneur will manipulate this and say the train is leaving the station, jump on now, and really get that sort of bandwagon effect going. We've talked about sexism, racism, and ageism. There's also another cognitive bias, is the Dunning-Kruger effect, where people know less than they think they do. So we've actually spent a lot of time with our investing strategy, and we have a fairly unique approach where we do staged investing with large upward steps in every investment so that we aren't tempted to give into sunk cost. We only allow one company in 3 to go on to the next stage, and we swap leads on it every so often to make sure people don't get too attached. And you can't have my deals go on, we're only going to be able to pick a few of the best. We do fixed investment sizes. We do at least 3 months of diligence per stage. We watch the company performance over time. This is the secret to getting bias out of your investment. The last thing which we do, the way we work, is we have over 500 advisors who can help support the entrepreneurs. So we're not tempted as VC partners to think we know better than the entrepreneurs do and tell them what to do. There are other experts they can talk to. Our job is really to support the entrepreneurs, mobilize the right people to get to them, to help support them, and allocate capital where it'll make the best returns for our investors. Now, I'm just going to show you, it's great to talk in theory about all these things you can do to reduce bias. The logical question is going to be, does that make any money for you? And I'm just going to pull up one slide here to give you a flavor of what this is about. So the data here is, this is private data, so I'm just going to pull it up quickly, and it's only a part of what we're doing. There was a disclaimer on the first slide about how, if you look at this is not a solicitation for money, et cetera, et cetera. But just so the one thing you can see here, these are the results that our fund has. We have multiple stages of investing. I'll just show you the returns to date on 2 of the stages. So we start everything off with a small $10,000 pilot investment. We've made the 200 of those. The returns on that are about 10% per year. Our follow-on investing, we've had returns of about 48% a year. And this is because of all these steps we take to remove bias from the follow-on investing. Now you can argue, look, why do we get better returns on the follow-on investing? Well, when you're existing investor, you have a systematic knowledge advantage compared to everybody else. You have a systematic access advantage. You already know the entrepreneur, they know you, and you know their business better than a newcomer does. What's really interesting is in the VC industry as a whole, they have roughly equal returns on their follow-on investments compared to their initial investments. So clearly, and by the way, around 11% is a VC average, VC industry average return over time. So the it looks like we're doing something right in terms of eliminating those follow-on investment biases, and that reducing bias does seem to be a good thing for a fund. Now, of course, this is data from just one fund, our own fund. Reducing bias may not be the only factor at play, so I have to give you that caveat, but we believe that it is at the core of our success and one of the main reasons that we're able to do well as a fund so far. So perfect, let me stop there and turn things over to you for questions. Yes, Steph Schaffer, who's asking here about, is there a way to apply or pivot this metrics-based approach for assessing pre-seed and or seed stage opportunities? And absolutely there is. That's something we do right now. When we run our fund, we'll often do pre-seed investments this way. You're simply looking at different metrics. So you want to start to look at, let's watch the development of your product over time. Are you able to sort of make progress on the product? Even if the product isn't finished, if we can see progress towards an end state, that's very interesting. Can you show, if you have small numbers of users and just a few pilot users, can you see good user retention? Can you see that people are excited in using this over and over? And you can start to ask questions. I mean, when we let companies into our pilots, we always do reference checks with people who have watched them over 3 to 4 months. As a minimum before we let them in. So a company needs 4 months of history of working full-time on the business before we'll consider it. But if you can just look at what has a company done over a 4-month period, for us, that is enough to assess whether or not it's worth putting some pilot money into the company to see where it goes. So yeah, you can do this in an earlier stage. You just need different metrics, but it's all very reliant on watching what the company's actually done.
There's another question from Jessica. What is your hiring process? How do you remove bias in the recruitment with respect to experience, age, gender?
Jessica, that is a really good question and a really challenging question. What we try to do right now, and it's actually been a question for us because we're trying to make sure that we have basically over 30% women, over 30% men in who we invest in our team, and in our investor base also. So we're really making efforts to look for women to invest in the fund, women to hire, etc. I mean, the first thing you need to do is you need to stand up and say, yes, I am going to have a target. So that's the very first thing. What we are trying to do, and what we've been doing so far, is to give people who come to us a chance to prove themselves out through a trial period where they work with us for a number of months, consult with our companies, we get feedback on them from the companies. Now, one of the things we've been wondering about recently, we've been saying, is this process still inherently biased because men are more likely to put themselves forward as a venture partner because they've just got the ego says, of course I can be a venture partner, and an equally qualified woman doesn't put herself forward. So we actually recently just went out and did our first explicit outreach to one of our top advisors who was not a venture partner, who hadn't asked. But when we went to her and said, look, you're a great advisor, the companies really love you, have you considered being a venture partner? She stuck her hand up and said yes. So I think that's one of the things to do in your hiring process, is don't just rely on who comes to you, but if you want to actively get balance, you may have to actively go out and look for and recruit female candidates. Look, we're not experts on hiring. What we're good at is investing. We can simply just see corollaries from what we're doing in investing to take to the hiring. Question here from Gunilla, which says setting targets as are necessary, as I think fundamentally merit has not been clearly articulated. Is this what you see? And Gunilla, I assume you're talking about setting targets for the percentage of your dollars as an investor you put into companies run by a woman, run by people of different races. And I think, yeah, setting targets, the problem is merit is very much in the eye of the beholder. And when you have the George Clooney lookalike pitching a business to you with wonderful promises of what's going to happen in the future, you get swayed by that. And you start to think, well, the fact that I like this investment means it's more likely to do well and perform well and be an outperforming investment. The honest truth is, you don't know. Maybe it is because he sells better. Maybe it's going to do worse because he spends all his time selling. He doesn't spend his time working on the business. You really have no idea. So this is why I think the challenge is that word merit. And merit can be clearly seen in metrics in the business. So the more you can get metric based, the more it's purely merit. But as long as it's sort of a human opinion decision hearing a pitch, I really, that is unfortunately in VC today, merit is the best pitch. And you need to set targets because the best pitch means the best looking man. Vinesh is asked a question, which is similar to others, which is, it seems like metrics are best utilized in stage 2 in the follow-on investments when you have actual metrics. Absolutely they are. But more importantly, we use a lot of non-numeric metrics in those follow-on investments because you can start to see, who is performing month after month on delivering their tech results. You know, that's hard to find a numeric metric to come up with to prove that, but you can simply say, they promised me this 3 months ago and they over-delivered on that. That is convincing. You can see when two founders seem to be fighting with each other and the business may have good metrics, but the fact that there's tension in the team means they're likely to split apart and it's maybe not a good time to invest, or you need to discount the company based on what you think is going to happen in the team. So the big advantage of that stage 2 is you have inside information, including but not limited to the metrics. Now, of course, when you spend multiple months diligencing a company, you have time to drill down on interesting topics as they come up and answer questions which you can see based on how the company's performance changes over time. So there's a lot of advantages of the follow-on, but I think you can use metrics at either stage. Yeah, James is asking, can we explain the stages that Loyal ramps up money in the companies? Yeah, so Loyal does a $10,000 investment, a $200,000 investment, a $1 million investment. We intend to also do $3 and $8 million stages, although we haven't gotten there yet. Yeah, so those are the stages. Only 1 in 3 companies can move on to the next stage. So we currently do 6 companies a month at the $10,000 stage, which means we can only do 2 companies a month at the $200,000 stage. Those 2 companies, we currently have over 100 active pilots going on, and we're picking the top 2 pilot companies every month to move on to the next stage. So really the proof of progress is be the top 2 out of 100 companies in that month. Now that can sound very intimidating. Don't worry about it. I mean, we just, we'll work with you, support you, etc., and see how you're doing. The best thing when you work with Loyal is just get our support. We may or may not fund you. Don't worry about it. Just run your business. If you do well with their business, we may show up and fund you. Even if we don't, we're going to give you advice on how to best proceed and be funded. So for us, it's always this comparative ranking. If you're the top 2 of the 100 this month, you'll get funded. And that top 2, about 60% of the time, the top 2 just means really fast sales growth. Sales are a remarkable indicator of success. But the other 40% of the time, it's something else. It may be tech progress. It may be really unusual metrics, which in small numbers, which we think might scale up. It can just be steady progress.
There's a question from Joanne. How do you generate the desired deal funnel, that is getting investable companies to apply for funding that allow you to meet your investment diversity targets?
Well, again, look, the second you set targets, then you start to work on things. I mean, how does Loyal do it? It's really simple. So one of our sources, and we only source from two places, it's alumni of the NCI Business School, and it is graduates of the Founder Institute program. By the way, the Founder Institute program is an open enrollment program, very quite straightforward to get into if you're serious about your business, very low cost, and you can do that. It's fi.co is the website. But what we do, for instance, is we'll call up the director of the Founder Institute program in Dubai, and we'll say to him, who are your top 2 companies in your cohort? And by the way, if one of the top 2 is not a woman, then also tell us who your top woman is. So we're ensuring that we're always seeing deal flow. But in our case, it's really easy because we just tell the directors who ran this program, top 2 companies plus your top woman if one of the top 2 isn't a woman, and then we'll make sure we get diversity there. We also do consider diversity when we're making trade-offs at the end. So we may end up with 8 or 10 companies which we're looking to fund, which we could fund in a month, and we're only able to take 6 of them. Well, in our case, we're giving people a pilot. We're giving them a small amount of money to try them out. So we're very happy to when we're making the trade-off between which 6 out of the 8 or 10 get in, we will use diversity as one of those criteria when we don't think we can really tell the difference between the companies in any other way. And again, look, if any VC who says this, who says I need to set myself a target of 10% or 20% of my money going to women founders, then they will start looking all of us and suddenly say, hey, I don't have enough women applying to me. How do I go out there? Where do I speak? What do I do to make sure I get more women, to make sure I get more people of color, whatever it may be, applying to my fund so I get diversity to match? Whatever, hire people from specific communities, get advisors from specific communities, make sure that you tap into those networks which you may not be tapping into. And by the way, by tapping into more networks of more human beings, you will overall should end up with better performing companies out of the bottom of that.
Sometimes we get this question, Kamal, that do you plan to pick up organizations or portfolio companies outside of the NCAD and FI network as well?
It's certainly something we would plan to do within the coming years. I mean, honestly, right now, we've got a process which is working. We've got a fund which is making really good money for our investors, and we have more demand. I mean, we have done very well in the communities we're in. So we were just on a call today with somebody from Saudi Arabia, because one of the things we're trying to do is we're saying we don't have any Saudi companies in our portfolio. It's one of the top 20 OECD countries, one of the top 20 GDPs in the world. And yet out of 200 companies, we don't have one company in our portfolio from one of the top 20 countries in the world. We need to fix that. So we were reaching out to him, and he's an NCAD alumnus, and he said, oh, wow, I've been hearing about Loyal from this person and this person and this person. And so we've done a really good job of getting our name out in a network. And that's actually really important as an investor, is you want to avoid negative selection bias. Investors always worry about seeing the worst deals, the ones that nobody else wants to fund. And our job is to sort of build such a name and reputation within a network that we get a chance to see all deals, including the best, not have the very best deals preferentially opt out of our funnel. If we were to partner with any other organization, we would want to set up a similar process to be sure we saw all of that organization's deals, including the best, and that whoever runs that organization would be comfortable actually recommending companies based on performance, observed performance over time. And if they can do that, then we'll be very happy to talk to them.
Next is, what can founders do to help remove limit bias from Jess?
Yeah, that is a really interesting question. So assuming for a second that this is advice for women founders, and we've already seen the gender confidence gap, one of the things to keep in mind whenever you are answering a question from a VC, what the other male entrepreneurs are doing, most of them, I mean, there's A-type, B-type, et cetera, personalities, but what many of the top, of the most likely to be funded male entrepreneurs are thinking when they're answering the question is they're saying, in their mind, if everything goes right, then this will happen. The male founder who said this is going to be $1 billion company clearly has no idea if it's going to be $1 billion company, but he's thinking if everything goes right, and then his mouth opens and says this will be $1 billion company. So one of the best things to do as a woman is when you're asked a question, think in your mind that they're asking the question, if everything goes right, what about this? And answer it appropriately. And that will make you sound more optimistic about the future, bigger visional, etc. So that's one thing you can do to help with bias. A second thing to be aware of is that most VCs nowadays actively want to see diversity in their portfolio. It is something that they're very conscious of. So you can definitely feel, and again, look, it's funny, I haven't had this experience as a woman. I'm very used now to speaking on panels where there's a whole bunch of women, I'm the only man. So I know how strange it feels to be in the minority and to be afraid to speak up about things that everyone else is saying when you're the minority. I don't know if it's good to speak up from that minority position anyway and say, hold on, here's something which you could do a better job of. Here's a way you're making me feel excluded. If that's a good strategy or a bad strategy, I honestly don't know. I mean, the one strategy I do know is the sort of, if everything goes right, answer the question that way. I see a lot of women who sort of say, should I have a man pitch for me? I don't think that's a good idea. I think own being right. And remember also, this is your investor. It's very much like a marriage. Having a bad investor is actually worse than having no investor at all. So really, the right investor for you, one who's going to be the right one for you to work with later on, should have the patience and willingness to listen. The other strategy you can use, and I mentioned it before, is pull the conversation to what you've accomplished. Play up your accomplishments, be proud of them, talk about what you've done, because the more you can move their framing from dreams of the future to what's going on in the present, the more likely you are to help them. But I can't guarantee that you can take their brain from dreams of the future into what's been accomplished so far. Those are some of the suggestions. Perfect. Are there any other questions? And people should feel free also, if you would prefer to unmute at this point to speak your question, you're also welcome to do that as well.
Kamal, I might jump in then, because I've had some questions pinged to me directly. Thank you. Superb. I think, frankly, we need more thinking about how to remove bias in the venture capital and angel sectors in general. One of the questions that has come in is, how do people nominate companies in?
So for Loyal, the only way in is if you're an INSEAD at this point. Well, there's 3 ways in. We don't advertise the third way very loudly, but the 2 ways are be an INSEAD alumnus, or more importantly, because that's not for everyone, do the Founder Institute Accelerator Program, fi.co. If you outperform the Founder Institute program, we will hear about it. In fact, you can tell your director to say, ask them if you're doing well, and ask them if they will mention you to us. There is a third backdoor way in, which no entrepreneur has ever been resourceful enough to use so far. I mean, we've had some people use it indirectly, but no one's actually, as an entrepreneur, said, I want to be funded by Loyal, I'll use this backdoor. And the backdoor is that any investor who invests in our fund, minimum investment $100,000, gets to nominate one company. So you can actually have, I mean, if you really want to be out there, you say, hey, here's someone I know who's got $100,000 to invest, and they don't want to concentrate it in my company because it's too risky. But if they can put it in a diversified fund, that'd be great. And the second they put it in a diversified fund, they can nominate me, and in fact, nominate me for automatic investment. Now, as mentioned, no entrepreneur has ever done that directly. A few of the advisors have, and the investors have said, here's a company I want to put in. But yeah, that's the back door. I'm not assuming anyone will use it, but maybe Australians are more resourceful than others.
Isn't there an Australian portfolio company who did this? Winely, didn't they?
No, Winely didn't do it exactly. That was one of our, well, they're half Australia, half New Zealand, and one of our investors is, she's married to a Kiwi, and she was spending a bunch of time in New Zealand, and she found the company. She said, hey, I really like this New Zealand-based company, because we were pushing her. We said, find a company. You put a lot of money in our fund. Why don't you find a company? And she said, okay, here's a good company out of New Zealand I like. Why don't we do this?
And I'm chuckling because the direct chat has just gone nuts saying, can you nominate us? And the answer is no.
No,
I'm not
James
really
cannot. Did you have other questions from your chat, James?
Sorry, Kamal. You actually have covered them. It might just be worth, while people are thinking of questions, etc., it might just be worth mentioning some of the Australian portfolio companies because they're out and about and busy. I think most of the audience is in Australia, although there are some internationals dialed in, and hello to those folks. They know who they are.
Well, I can mention a couple of the Australian companies. One is a food company called Makala. They do organic, gluten-free, nut-free Thai in Asian sauces. And they are, the founder is now in Australia. She's married to an Australian guy, and they decided to move back to Australia. Other factories actually in Thailand. And if you want really flavorful organic sauce, you can check it up. It's Makala Living. I'll stick it in the chat here. So you have it. A second company we have is a company called, and by the way, Makala's got an amazing story. They use Burmese refugee women to work in the factory. They don't read well, so they use symbolic training materials to make sure they can train them to work, etc. It's just an amazing story. You can feel really good about the food you're eating if you eat with them. We also have a company called Unhedged, whose mission is to make hedge fund investing accessible to the average Australian. Now, they are still only open to accredited investors or sophisticated, I don't know what they're called in Australia, but they are doing work to get licensed to actually be accessible to the average everyday investor. And you can actually, I believe, sign up on their website to be on the waiting list to be informed. Needy has mentioned a company called Eclipse. And I'm just trying to remember which one. Eclipse, yeah, Eclipse AI. They want to build an automated management consultant. And I know that sounds absolutely crazy, but they're actually doing it in a really smart way and making some really good progress towards that. And yeah, and just sort of get the right metrics out of you and use the metrics from your business to help ask you questions and drive you towards likely sources of improvement in your business operations. I'm going to miss one or two, James, so why don't you speak up? Javika, just talk about the last couple.
Sure. So Javika, I'll put them in the chat in a second, but Javika, who is, that is www.remint.com, REMINT.com. She's doing basically a smoother process for online resellers. So trying to help boost the circular economy and make sure not so much fashion and particularly high-end niche designer brands in particular, of which there are many, and Australia is actually quite well represented for those, that those communities don't have product going to landfill and actually solve a scarcity issue where you can't always get hold of pre-loved items necessarily. So she's doing very well.
Now, you did mention Winely earlier. I always think of Winely as a Kiwi company rather than an Aussie company, but in any case, they do. They help wine companies optimize the fermentation process. So it's very sort of technical improvement in management of fermentation, which means that the wine making process is more efficient. You get more wine that tastes good and less wine which is wasted.
Very true. There's also, just scrolling through, so Unhedged, Eclipse, Remint, Winely, Cellar.
Oh, of course, Cellar, yes, Cellar, and they are out of, was he out of Perth, I believe, sort of the back of beyond there, but they do, come on, I mean, Perth is a long way from anywhere.
We're not just Sydney-centric folks, I promise.
but they basically help manage authenticity and support marketing of winemakers, honey makers, etc. So you can track the bottle right from the vineyard to the consumer, and it's good for the consumer because they know the bottle's authentic. They can see everywhere it passed through, but it's also good for the vineyard because the vineyard can start to see who's actually drinking their wine rather than them shipping it to a wholesaler and it just disappears and they don't know who their end customers are. There's a question here from Vinesh which says, with the biases we compensate for, sunk cost, endowment effect, overconfidence, and so on, are we logging data on each of them to see which individual ones are working to create better results? Well, so what we did is when we set up our process, we gave ourselves a series of rules. I can tell you that those rules are really, really hard to run. Entrepreneurs are masters at emotional manipulation, for instance. So it is so easy for the entrepreneur to be like, oh my God, I love you, support me. This endowment effect, it's so real. And I can tell you that I'm seeing the pain inflicted by our rules when we can't invest in good companies, when we can't support good entrepreneurs, because they're not in the top third, they're not the top 2 out of the 100 in the month. So we are not explicitly logging data on them, but I can see example after example after example where our rules are forcing us to make good decisions, forcing us to diversify appropriately. I mean, the overconfidence where people put way more money into some deals than other. And by the way, that is one of the causes. I didn't play it up, but one of the reasons only 2% of money go to companies run by women is women will often raise less money at lower valuations than men will. And this whole thing of, okay, well, somebody's asking for 600,000 to meet their plan, so I'll give the guy 600,000, the woman only wants 200,000, so only give her 200,000, is one of these sort of gender parts of overconfidence you can see. And in our case, when we decide to put more money in, it's just going to be, hey, here's $200,000, and I don't care how much you think you want, $200,000 is what we're putting in. So some of those rules are really, yeah, they're working really well. I mean, our entrepreneurs, we're very clear to communicate upfront when they come in the door, what our process is, what to expect. And I think generally they understand how and why it's working the way it is. Do some of these things, sunk cost, endowment effect, overconfidence effect, will they give better results? I honestly don't think so. I think in the long term, it depends what you're trying to do as an investor. In our case, we're trying to get good excess returns. I mean, I haven't shared the combined returns data. I'm not allowed to say it in a public forum, but you could certainly see how the follow-on investments were outperforming. They are the bulk of our portfolio. But our goal is to just have good excess returns while managing the downside, because many venture funds will actually lose money. And we're trying to manage our portfolio in a way that we've got enough of a diversified base so that even if some of our bigger bets go bad, we still are protecting capital. And most VCs don't think about protecting capital. They're thinking about home runs every time, and sometimes they'll do it and sometimes they won't. Good. I think we're just about to time here. We've got 2 more minutes. So we've got time for one last question. If you've been sitting back shy and haven't wanted to ask the question, now's your chance. I've been told, by the way, I should leave 8 seconds after that period to give people time to just really get their courage together. All right, well, if there's no further questions, thank you very much for coming today. Hope this has been useful, informative. Do feel free to be ambassadors everywhere in the Australian ecosystem for sort of making sure investors start to think about how bias is influencing their decisions and have them start thinking about reducing bias so that they can make more money through funding truly the best entrepreneurs, not just the ones that pitch the best. So thank you for being those missionaries for us, I hope. And it's been a pleasure to meet you all. Hope you've enjoyed it.